Good morning, good afternoon, good evening from wherever you may be joining us. And I'm delighted to be hosting today's webinar, which addresses tax issues around international students. Now, as Director of Education Services, I've worked with many families whose children are heading overseas to study. And one of the areas we've never been able to cover is tax. So it's absolutely wonderful to welcome Peter Ferrigno, who can, with his vast expertise, fill in this gap. Now, Peter has recently joined Henley and Partners as our first Director of Tax Services. Peter's been a tax partner for over 20 years, including at two big four firms, where he specialised in the cross-border taxation of individuals. He's also spent over 20 years of his career living, working and practising tax in various countries outside his native UK, giving him experience of many different tax systems and how they affect individuals from multiple different nations. So Henley and Partners Tax Services works alongside your existing tax provider to provide the bridge between your overall global position and the right in-country provider for the country where you'll be or you're planning on studying or investing. So please, as we go through, if you have questions, please, you can either add them in the chat because I'll be bringing them up at sort of strategic parts or points in the webinar. We're also going to have a Q&A at the end. So, you know, just feel free to add questions throughout. And on that note, I'm going to hand over to Peter, who is going to take us through this whole webinar. Thank you, Peter.
Well, thank you very much, Tess, and welcome everybody. And it's nice to be here. We're doing my first official outing in Henley and Partners colours after joining on the 1st of October. When I first joined, Tess and I got chatting like you do, and talked about when students attend university internationally, they're often supported by their families. And this support can take a variety of ways. This can be cash allowances, or sometimes it may be income from assets, whether it's trusts or grandparents or property. And so this can create tax issues that often get overlooked or don't get considered. I've had a couple of client cases about this in the last year or two, which was why I went to seek out Tess when I first joined. And hence we thought that would be something that you would be interested in. So hence why we're here today. Now, tax is typically triggered by presence in the country. And so if a student is in the country, they would be subject to tax residency under normal rules in that country, although accepting that as a student, they often won't have any income, so there may not really be any tax that they need to worry about. However, certain types of financial support can trigger wider tax issues for the family. And you're going to come on to things like if you buy an apartment for your offspring to live in while they're at university and you rent out some of the rooms to their friends, does that create a tax problem? And of course, some students are able to work where permitted, and of course that will have tax impact. Typically that's in the country where they are, so not too difficult, but in these days of online remote working, it can be a little bit more complicated than that. So what we're going to do is take you through the first, typical ways of which students can be funded. And we're going to cover the tax aspects of each of those, just so you're clear where you've got questions that might need following up on and where you can sleep peacefully without worrying about it again. And the key thing, majority of students, majority of the time, it's cash allowance from parents or family to cover the fees and to cover the living costs. And I'll put those terms there deliberately, as you will see later. Working, students do work. It varies very much by country. Some countries have a very strong working your way through college culture, like the US, where even your jobs can be tailored around that. Other countries, it's less normal and less expected. Some people, of course, save the money before they go, and amounts saved prior to going off to study will also be a factor. And of course, you've got trust funds from family or even the educational charities in the country that you're coming from. Those will potentially be a form of support. I mentioned also buying property and in the country we're studying and subletting to other students. And some cases we've seen simple asset transfers. So here are some dividend producing shares. Here are the shares, live off the dividends or whatever. These things can happen as well. Or if part of a broader family restructuring, the student already has assets of their own. Tax treatment of these will depend on two things: the country of the source of the cash and the tax residency of the individual that's receiving it. So let's talk about tax residency to start with. Tax residency is very different from immigration status of residency. You know, with Henley, we often talk about residence by investment, citizenship by investment, and residence by investment is the right to reside in the country. Status. Tax residency is distinct from that. It usually follows quite closely for the majority of people that don't cross borders too often. But that if you are allowed to be in a country but you're not there, that doesn't make you tax resident. You only become tax resident when you've got enough physical presence in that country, which is typically under many countries' rules, been in that country for more than 183 days in the tax year or on a rolling 12-month basis. Now, 183 is half of 365, rounded up, which makes a certain amount of sense. And that's why you see this magic number in tax treaties. Now, some other countries can say, you know, it will be less than that. I was looking at some stuff for UAE today. I think there's a 90-day test there where you can start to be resident. Some countries, just having the permanent home or available accommodation is enough, even if there isn't a day count. And so that is something to watch out for. And the words available accommodation, I will come back to. Individuals can be resident in more than one country. Every country has its own rules. So therefore, it is possible that you can be in multiple tax resident, multiple countries at the same time. Worst I think I've ever seen is 3. Usually, unusually if it's more than 2, but if there are 2, you then have a double taxation agreement, which are bilateral instruments between 2 countries, where one country says what they, you know, how they will treat the residents of the citizens of the other country, both from an income basis and a source basis. So a double tax agreement is designed to encourage trade and investment and clarity of tax treatment between the 2. Now, I would note it's called a double tax agreement. It's to avoid double taxation. It's not, there are occasions in the past when you might be able to avoid tax altogether, but that's less likely. A double tax agreement typically says where you've got a person in one country with income in another country, or income in one country owned by someone from that other country. So you look at it both perspective of the source and the individual, and we'll come back to that. Most double tax agreements, rather helpfully, have an article called students, but well, residence first. So the residency there is where if you have resident more than one country, you then look at a tie-break test. So you look at where someone's permanent home is, where someone's centre of vital interests are, where they habitually abide, and then if you can't decide based on that nationality. Most double tax agreements follow a standard which is usually based on the OECD model, but can be based on the United Nations model if you're coming from a developing country. That in turn is based on the OECD one. And this article is relatively consistent, but it has evolved ever so slightly by standard model by standard model. So an older double tax agreement may not look identical to this. And the reason why that matters is if you can only be resident in one country because the country where you're resident will tax you on your worldwide income, and the country where you are non-resident, they can tax you on sources in that country. And income earned elsewhere is not considered taxed or taken into account in that country. So determining where you are tax resident is vital for everything else, because double tax relief will also apply, but it does need to flow in the correct direction. The student will often become tax resident because of the 183-day test, but of course, if they are retaining their home in their home country and go back for every holiday, then it may be very close, and they may not have broken the double tax agreement residency criteria in the home country. So it's very important to look at each individual treaty. And I say care should be taken if assets are acquired by another family member, then you don't want them to be taxable as non-resident. Classic example, parent buys the apartment in London when the person's studying in the UK, sub-rent some spare rooms to other students or friends that are there. If that income is owned by the parent, then that parent is potentially A, subject to tax on that as a non-resident, but B, does that make them resident because they have available accommodation? Something to always watch out for. Most of the time you can just be clear that that's not the issue, but better to be alert to it and avoid the problem. So I mentioned about student articles when I was getting ahead of myself a little bit earlier. So when a student or business apprentice is visiting a contracting state, and immediately before that they're a resident of the other country, i.e. so they've just left home to go off to university, then any payment that's made solely for the purpose of education or training, or they're solely there for that purpose, and they may receive payments for the purpose of maintenance, education or training, that won't be taxed. So giving someone money to pay the student fees, to pay their accommodation, to pay their living expenses, that doesn't create a taxable event. And there's no restriction actually in that, whether it comes from parents, whether it comes from wider family, trust or other sources, brothers, sisters, spouses. But it does say where they're present solely for their education or training, and they receive the payment for maintenance, education or training. So if you give them the money to go buy a house, give them the money to make some investments, then you've got to be careful. And certainly once you've created income generating assets, then that income isn't money that's given or grant or financial support. That's income where you need to look at how that income itself is taxed. So let's run through some basic categories of income from the double tax agreements. I mean, employment is very clear. That's usually taxable in the country where you're resident, unless it's performed in another country. So when you are working while you're studying, that country has the first right to tax because that's where the work is being performed. Secondarily, if you retain your residency in the home country, you may also be taxable there, but double tax relief would be available. You would need to file a double tax return to claim that. Now, self-employment is pretty similar, but there's a little thing to watch out for there, because that's where the business is carried out. And in the days when, if you would do something while you're a student, you would typically be working, close by, selling something, buying and selling something while you were there, or trading in t-shirts or whatever, then that's a business carried out and it's performed where the services are performed. But of course, if business is now increasingly done online, and you see more and more students having .com startups or internet businesses, or selling Pokemon cards on eBay, and then where does that really take place? And so you've got to watch out for that as well. And that country of residence will be able to tax and give double tax relief as well in the country of residence. So if you are handling and selling physical goods where that sale takes place, is often a good indication. If you're posting them all around the world, again, more complicated. Real estate is the one I've alluded to a couple of times before already. That's the one where I first started to see these problems arising. Often a parent or a family trust will buy a property for the student while they are studying, or even the student, it may choose to go out and get a mortgage of their own, put together a deposit from their working, buy a property and sublet to other students. Now, rental income is clearly not income that's been received for your maintenance or training or education. So therefore, that rental income will always need to be reported and taxes calculated on that and payable if necessary. Now, if to a certain extent the flatmate or the housemate is just covering their share of the bills, then that's less of an issue. However, if their bill is a utility bill, that's fine. If the bill is a mortgage, you can't really argue that that is just covering share of the bill. So it should be looked at and checked for whether there's a tax liability. If you're the parent that's bought this and the property is in your name and you have a landlord agreement, then you have the obligation to report that and pay the tax. Should you have the income at the right level? Most countries, rental income is taxable from a pretty low base. Now, if you borrowed money, some countries will allow you a mortgage deduction. You can typically deduct the expenses, whether there's a service charge or whether there's insurance or whether there's repairs and maintenance. But real estate is the area where we've often seen this come up most often. The other one is financial assets. Now, often if you've got resourceful families, then they may choose to give the adult child that's studying some stocks and shares or some bonds, or often either there will be dividends or interest received on that, or there may be capital gain if they buy and sell. So trading trading stocks, trading cryptocurrencies are always going to create income, but those also aren't covered by the double tax relief part of the treaty, or the student article. So those will be taxable, and those will need reporting and tax to be paid as and when. And this again is something that's often overlooked, particularly if the stocks and shares or the bonds are in a different country. Let's talk about a few other things as well, because once you're in a country and once you're a resident there, then things can get a little bit messy sometimes. Some countries have inheritance tax and gift taxes, and some countries don't. So there's a difference between, paying money for the maintenance and the operating expenses of studying and a pure outright gift. And so if you buy your child, or if your parent buys you a car or buys you, or even gifts you the apartment, you're always going to need to look at what the gift and inheritance tax position is in that country. Now, we've put some examples here. Quite a lot of countries where international students that use our services come from don't have inheritance and gift taxes. So at that level, it may not be top of your mind to think about that when you are sending someone off to university. You may think, okay, well, I'll worry about that later, but it may not be that easy. Now, some countries tax at the donor level and some tax at the recipient level. Sometimes the rates differ depending on how close a relative someone is. So someone that's a direct lineal descendant, a child from a parent, may have a lower tax rate than if it comes from an aunt or an uncle or a cousin. But something always do that. Now, if you know that if you're coming from a country without gift taxes and going to one that's got it, top tip, look at doing that before you move rather than after.
Yeah. Peter, just a quick question about this. This is really interesting. How common is this? Because we obviously work with lots of families. How many approach you with these sort of tax issues?
Not as many as I think have the issue. So I think most people fall under the exemption of Article 20 and think, well, it's just a payment for accumulation and maintenance. And then, there is a question of, if you're paying for accommodation, does that include buying a house? I suppose it depends if you're buying the house and they're giving the money back at the end of it. I think everything's going to be, very specific to those facts and circumstances. And I think, we do clearly see both domestic and international students now, where now the fees are much higher than they used to be in the past, relying on financial support rather than working their way through college. And sometimes that can be loans, sometimes it can be outright gifts, and sometimes it's good tax planning to give the gift early. And the UK, for example, has a 7-year survivorship thing to be exempt from inheritance tax. So if you give someone something when they're fresh-faced and 18 and off to university, you've got it to spare and they survive 7 years, that's a way of getting around inheritance tax. But of course, you have then given the assets away, which is the thing that always worries people. Yeah,
very interesting.
So the other thing about gifting is some countries have an exit tax. So you may have given someone a stock portfolio worth €1 million so they can live off the dividends. And when they leave the country, the portfolio might be worth 2 million. So you've got an unrealized capital gain, but some countries may say, well, if you're leaving the country at the end of your student years, you're deemed to be disposing of everything and crystallizing a capital gain in that period. I know Canada does that. I think Germany can in certain circumstances. The US can if you're giving up citizenship, but that won't always apply here. So again, watch out for that when the period is over as well, rather than just before. Because as I say, it was the next slide here. So when people do leave a country and they've got unrealized gains, say it's treated like they sell the assets either on the day before or on the day of selling. And particularly if you've got real estate, say you bought that apartment and it's been sub-rented to a couple of friends and one of the friends is staying on to do a master's for 2 more years. So you're hanging on to it to rent to him, and he may or may not stay there for longer, and it's a good investment because it's a prime location anyway. Watch out for that, both A, when leaving, and B, later on, because that will still be income that's subject to taxes and once you become a non-resident. So, not the longest slide deck in the world. It's not the most complex issue. I think all we've done is sort of highlight the key things here. But I think simple student support, like I say, is going to be straightforward. And that's why I think, as you said, 90% of your clients never even raise this as an issue. Because most people, it's coming out of income if you can afford for your, or if you can afford for your students to, for your children to study abroad, you've already scrimped and saved. A lot of times it's coming out of savings which have been, taxed on their way through over the past 20 years. So spending savings is rarely taxable. If the employment income and investment income, there are standard rules for ordinary taxpayers which also apply to students. So it's not really a surprise there. It's just remembering that those exist. I think also if you retaining residence in the home country, not forgetting about the obligation to file there and claim double tax relief as well is important. But I think the most important thing is where there are complex and asset-based arrangements, those should be reviewed just to avoid any surprises. It's easy enough to get these things done in advance. I think when we sit down with a client and talk through it, we tend to charge just a few hours on an hourly basis. It's not the most expensive part of sending a student off to study abroad. Quite arguably, it's one of the cheapest things that we do in that respect, not to undersell the value. But if you're bought into the idea of getting the foreign education package, then making sure that you've not got any nasty encounters with the tax authorities is also always a good idea, particularly for parents that are buying accommodation. If you're in a country that has an available accommodation test, you've bought that and you say, oh, that's handy, we'll keep the spare room, and every time we come and visit, then we've got somewhere to stay, then that is potentially available accommodation that could potentially make you tax resident. Easy to avoid if before you get there, not so easy to avoid after you've spent 3 weeks there visiting your student child, and at the same time closing a deal to sell your company for $200 million because you happen to have the free time because you're out of the office. Don't try that at home without talking to us first. Not that happens that often, but that's the kind of worst case scenario.
Yeah, well, I was actually going to ask Peter, what sort of problems have you seen arise from parents who've, I think if I was a parent, when my child did study abroad, I have to say it didn't really cross my mind. And I'm just wondering what sort of pitfalls can our clients and other parents avoid by coming to talk to you?
To be honest, the most boring thing is registering for tax, getting a taxpayer ID number, and filing a tax return for the 2 or 3 years that they're there. And that's ultimately what we ended up doing. It was just finding out where the money was coming from. And if you've got $1 million worth of shares with a 5% dividend yield, so you've got $50,000 of income to report, then that's going to be an inconvenience. There's going to be $10,000 tax on that, or whatever the number is, but that's $10,000. You just got to register and pay. Alternatively, once the person stays for a bit longer, once they graduated and they decide to stay in the country and they start getting into the tax system, what year did you arrive? What income have you had? And then, okay, well, we should be going back to the date you arrived as a student rather than the date you started work. Yeah. But they're very much, most countries work on a honour and trust system, but of course, the moment they've got a reason to look into you, and you're politically connected persons or something, it could be one of those things that you just want to be extra careful about, of course. But the majority of cases we end up just filing tax returns and paying a bit of tax, and that's the least exciting part of my job, unfortunately, but it's the bit where more percentage of the time gets spent than I'd like to admit.
Yeah.
So, yeah.
Okay, that's
I think the biggest thing is where assets need to get reported, and also, some countries do have a wealth tax, not that many, but some. And so if you've given someone 5 million and they've gone to Spain, Spain's got a wealth tax. The other one about inheritance tax also is countries that have forced succession, or where the tax is based on the recipient rather than the donor. So if someone is happily at university in a country where inheritance tax is paid by the person that receives the assets, then if they automatically receive that under a forced succession law, grandparent is ill, do think about whether they should not only just come home to say goodbye to grandma, but also come home for tax reasons too.
That's interesting. And just a couple of really sort of functional questions. Can you just confirm for everybody that our tax services is a standalone service?
Yes, so Henley and Partners is isn't authorised to provide tax services. That's done through a separate arrangement. So it's not included in any other services. However, when you're working with Tess, getting your education sorted, and you want me to come in and talk to you about that, we'll do a separate arrangement there, give you a quote to how much that will cost based on how easy or difficult it is, and that will be on top. So alongside.
Yeah, no, I was just going to ask, it would be really helpful just to run through what does the process look like. So we're working with a family, they say, oh, we heard this webinar with Peter. What do we do now if they want to speak to you, Peter? How do you work with or go forward with a client?
If they've already gone through the client acceptance with you, then that's quite straightforward. We send them a separate engagement letter which they sign with the firm that's actually the regulated tax advisor.
Okay.
And then we have a questionnaire, or a simple half-hour call where we run through all those things. We'll produce a simple report or summary. It can be 2 or 3 pages long. It doesn't have to be that difficult. And then say where there's an issue, where we don't think there's an issue, how to do things differently. And also if, for example, there will be ongoing tax services needed during the course of the studying period, then to put in there how much it would cost to do a tax return every year.
Yeah, okay, well, that's super helpful. I have got a question that has just popped up. So let me just read this out. So is there a tax scenario that the parents who stay in home country would become tax residents of a foreign country when the minor age son or daughter is studying abroad for several years?
In most countries, fortunately, you become a student at 18 when there is when you're deemed to be a taxpayer in your own right. So it's not there are occasions I know where people go off to university a bit earlier if they're smart and they had good schools and feeding. So, but usually the minor child or the child going to study doesn't create the residency of the parent. The only time would be if the parent does something like buy the accommodation, have the available accommodation test, or decides to go and spend more time in that country and triggers a threshold of 90 days or something like that to make them resident. It doesn't mean they can't still retain their home country residency based on the double tax agreement, but if it's convenient just to nip over and see them regularly and you think, oh, well, let's go there for the summer holiday and let's go see them for Christmas rather than have them come home, you just got to be careful.
Okay, thank you. Now, are there any other questions? I don't think there are at the moment.
So the main thing is parents buying the accommodation. That's that's always the one that comes back to bite. Yeah.
Okay. Good. So how can people contact you, Peter? Have you got a slide?
Well, let me just go through here. So once you've decided on the country, we can discuss it with your tax advisor, lawyers, and your financing arrangements, and we can make sure that we're doing the tax work in that country. As we're authorised and regulated in the UK, if people are coming to and from the UK, we do that directly. If you're going to the US or other countries, we work with a series of trusted providers there that we've worked with for many years in previous lives. And how to contact me? Well, this is me on the back page, Director of Tax Services. That's my phone number and my Henley email address. And so just send any questions through and we'll be very happy to help out.
Great. Well, Peter, thank you so much. Thank you, everybody, for being here. And feel free to reach out. I haven't put my email there, but it's tess.wilkinson@henleyglobal.com for all your education needs. Otherwise, Peter, thank you very much. Thank you, everybody, and we'll see you next time. Thank you. Goodbye.
Okay, thank you, everybody. Goodbye.
Bye.